recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view.
How does the greatest investor of all time, Warren Buffett, think the average person should be investing during a stock market crash? Except for Jeremy Grantham, who is usually yelling. Nothing is screaming that a stock market catastrophe is imminent, despite the fact that the market has increased by a very average amount this year. In any case, the purpose of this video is to ensure that you're ready for the inevitable stock market crash that will occur at some point in the future, because by the time it comes, it will be too late. When they do occur, these occurrences are rare and, despite their potential for fear, are the finest times for investors to earn large profits. The advice that Warren Buffett is giving today will help you survive the stock market crash. Some people should not hold any stocks at all, since they're easily agitated by little changes in price. You shouldn't hold any stock at all if you're going to make foolish decisions because your stock is declining. What are the stupid decisions? It's giving up a stock. Yes, selling a stock as its value declines. Time in the market is, after all, far more significant than timing it, and this principle is especially relevant in the case of stock market disasters. Everyone believes they can avert a stock market meltdown by selling their shares at the peak and repurchasing them at the bottom. And although this seems possible, it's not true. No stock market disaster has ever happened that looks exactly like the ones that have come before. Some fall 30%, others by 10 or 12%, some for years, and some just last a few weeks. They also don't always follow the same pattern. Being scared about the crash can't help you succeed. We can't stop you from trying, but it will be a huge waste of time if you believe you can accurately determine when to sell a stock and then purchase it again. We can never predict what the markets will do. It may sound contradictory, but you need as much time as possible in these markets because market crashes are rare. The stock market fluctuates on a daily, monthly, and annual basis. Yet, when we extend our focus sufficiently, we find that the market consistently rises. Companies create new products, increase productivity, innovate, lower the cost of goods, and stimulate economic growth. Hence, the best and maybe the only prediction that you can make when making large stock market investments is that, in the very long run, the market will almost certainly be greater than it was. An index fund, such as VTI, is a stock that measures the performance of a basket of various firms. It was founded by Vanguard and tracks the performance of the whole U.S. stock market. Investing in an index fund effectively means purchasing all of the firms in it. You don't even need to select which specific companies you believe will perform well in the future. For more than a century, one of the greatest long-term investments has been to buy a portion of the U.S. stock market in this manner. However, in what specific ways are index funds to be used in the event of stock market crashes? For one thing, stock market crashes may be frightening. If you have a plan in place to invest regularly throughout the year, no matter what, you're far more likely to adhere to it than to stray and behave irrationally. The second is that you should invest the same amount each month, or every few months, for example. Your money will increase in value as stocks decrease, since it will be allocated in proportion to the state of the stock market. For the majority of his life, Warren Buffett has made significant investments in businesses that he adores and intends to cling to forever. As a result, you have to consider each purchase of a single stock as a lifelong commitment to researching and interacting with the business and its sector. A corporation experiencing financial difficulties or a stock market meltdown is typically indicative of an underlying economic issue or suffering. Therefore, companies without debt will be significantly more equipped to withstand the storm than those that are heavily indebted and must simultaneously deal with a recession. Buffett illustrates this idea for investors using a concept he refers to as the circle of competence. Is the box labeled knows and is important recognizable and significant? Is there anything inside, and can you distinguish what's inside from outside? That's what we refer to as being aware of your area of expertise. The concept is that, despite how alluring it may be to rush into your next hot stock, you should just ignore everything else and learn about a select few sectors or business models. Buffett's areas of competence are banking, energy, and consumer-facing products because of his understanding of customer behavior. Making a list of everything you know more about than the typical person, perhaps from your job or hobbies, will help you identify your circle of competence. List your hobbies and passions after that, along with the goods and services you use most frequently. Being a consumer in a certain market or sector may frequently provide you with valuable insight into the reasons behind the success of some businesses and the failure of others. Speaking about businesses that have consistently achieved success, Buffett enjoys purchasing only the best businesses, those with a strong track record in the field and the capacity to stay at the top. The desire to do this is motivated by two very sound reasons: capital preservation. Don't lose is the first rule of investing, and don't forget that the first rule is the second. The main goal of investing is to preserve your money rather than expand it as much as possible. It is quite difficult to recover financial losses incurred when pursuing bigger profits. First and foremost, investing in excellent companies is the best method to avoid suffering significant, irreversible cash losses. Although there are several methods to assess a company's quality, the best companies invariably have a wide economic buffer. We're looking for a firm that has a broad, durable moat surrounding it, one that can safeguard a fantastic economic castle under the leadership of an honorable lord. A distinctive quality that offers a long-term, sustainable competitive advantage is known as an economic moat. From a qualitative perspective, it may resemble a strong brand that enables a company to set prices for its goods. However, a moat may be quantitatively assessed by examining the return on capital for the business. A company that generates a high rate of return on its tangible assets is beneficial. The theory behind this is that companies with a wide economic moat would be able to persistently outperform their rivals in terms of long-term capital gains. Returning to the brand example, a firm with a strong brand is able to charge a higher price for its goods because they can generate more profit, even if the cost of production and running the company may be the same. Consequently, they will outperform their rivals in terms of return on capital or return on investment. In 2023, Buffett told CNBC's Becky Quick that his approach to a recession is to keep plenty of cash on hand so that people are going to keep making intelligent decisions rather than those forced upon them. As reported by Motley Fool,
A company that was earning 15% on equity worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
you can take actions such as avoiding investments that might tie up your funds, even while you can't accumulate billions of dollars in wealth like Berkshire Hathaway. Blue chip stocks are subject to market and economic downturns, like any other. Therefore, you should exercise caution when investing in a firm that has experienced a decline in sales and share price. Buffett did, however, note that it's often just a little setback. In 5, 10, and 20 years, the majority of large corporations will be breaking earnings records, he said. Buffett stated on CNBC that he thinks before a recession, one should do business as usual. While you don't want to abruptly cease investing, you also don't want to take risks by buying more stocks than you usually would. Buffett told CNBC, "We just want to buy good businesses run by people we like and trust at a decent price, and we'll continue to do that." Before a recession, it might be tempting to seek a safe haven by putting all or most of your money in low-risk checking and savings accounts, where the chances of it growing are slim to non-existent. However, stocks will almost certainly outperform cash over the next decade, probably by a substantial degree, according to Buffett's NYT article. While some recessions are shorter than others, they are all transient. The stock market, on the other hand, has a lengthy history of increasing in value. This was the situation after the 1930s Great Depression, the 1970s and the 1980s economic downturn, and skyrocketing inflation, the 2007 to 2009 Great Recession, and the COVID-19 epidemic earlier this decade. If you witness a decline in your assets both before and during a recession, don't freak out. Rather, continue to think like Buffett and believe that the stock market will rise again, since past performance has shown that it always does. Comment with your thoughts below and subscribe to our channel for more updates.